Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to CEO Jerry Randall and CFO Daniel Wells of Venture Life, a leading over-the-counter consumer healthcare firm. So welcome, gents.
Thanks, Paul. Good to be back.
Thanks, Paul. Nice to meet you for the first time.
Well, yeah, great to speak to you, Danny. Now, big congrats on today's inline full year 2021 results and positive start to 2022. But before we sort of dig into the details, Jerry, I don't suppose you could give us a bird's eye view of really the sort of health of the consumer, because you see sort of like so much at that sort of the cold face. What's given the cost of living crisis?
Yeah, sure. I mean, our products, we would say have a need state. A lot of the people who buy them need them. They need them for obviously treating conditions or maintaining their health. So whilst it's not fair to say they're completely price insensitive, what we have seen is that there's an acceptance of the price rises. When we put through price rises across all of our products and brands across the UK and across internationally, and there's, sometimes there's initial resistance, but we've put up those prices in the UK retail, in the pharmacy, and in the grocery multiples. And yeah, they've all been taken and accepted. So we see, if you've got products that have a strong need, particularly in our case, medical consumer need, then they're going to be resilient. We haven't seen any signs so far of diminished consumer demand. In fact, it's probably building slightly from last year.
And that gives you sort of plenty of levers or another lever to pull if you need to at a future date, isn't it? If we do, I mean, obviously we all know inflation's hitting consumers, but if it sort of even increases further, then you've got a loyal consumer base there, which sounds good.
And we are loyal consumers, niche brands, in a good place of need, and so yeah, they're holding up.
Good. And then Danny, just turning to you, can you give us a quick sort of like 10 pence on the sort of key highlights for last year's results, and particularly sort of like the focus on the exit run rate, the pro forma?
Yeah, absolutely, Paul. I think what investors will have seen this morning is that Venture have had a very strong second half to the last year. We've got a newly enlarged group, completed our largest ever acquisition. H2 revenues were up 36% versus the previous year. Q4 revenues were up 59% versus the year before. And in Q4, we had a full impact of those acquisitions in the business. So heading into the current year, I think investors can get a very good feel for the underlying run rate or pro forma value of the business. And of course, that value, I think it's worth highlighting, doesn't include all of the cost synergies impact that has been realized from the BBI business. It was a large acquisition, and the business has been able to achieve some very nice planned savings. And I think that gives us confidence in our exit run rate and our ability to at least maintain that despite the pressures that we're seeing in the supply chain.
And what's that sort of quantum on the synergies there, Danny, on the cost side? Are we talking seven figures?
We are indeed, yes. So we, as part of the acquisition, Venture identified over £1 million of cost synergies, and a large chunk of that has already been realised at the back end of last year. But you've only got a partial impact of that in the numbers that you will have seen this morning. So until you asked about the run rate, Paul, and where H2 trading was, I think what you can see there is that the full impact of those cost synergies on a full year basis is still to come through.
Fantastic. Well, yeah, I mean, I was just noticing, actually. I mean, I haven't seen the latest figures from Singers yet, but I know they're pitching in with an adjusted EBITDA for 2022. I think it was £8.1 million, and your exit, well, not yours, but Venture Life's exit run rate was 7.9, as you say, without those synergies. So yeah, I think as a prospective investor, that would give me a good confidence, which is great. Just Jerry, now in terms of another thing which has come through the headlines, obviously we've got inflation, we've got cost of living crisis, and all blah blah blah. But we've obviously got the lockdowns which have started in Shanghai and now in Beijing. Can you give us a sort of like a quick view of what you're seeing at the coalface in terms of China? Because you obviously appointed the new distributor.
Yes. I mean, we appointed Samarkand back end of last year that you all saw, and we shipped our first shipment of product out to them. Went out right at the start of the year. That's been received. It's in the warehouse in China, in Shanghai. Obviously, there's huge congestion within the ports in Shanghai at the moment. Our product got through and in, But because of the lockdowns, obviously, it's difficult to get people out and get that into the stores. I mean, a lot of their business model, Samarkand's, is to sell online. So it's not footfall. So they're still marketing, they're still selling, but at the moment it's difficult to move products out of their warehouse to customers. So I think once the lockdown finishes in Shanghai, and I know at the moment I think it's been slightly extended, but even if it's a few more weeks, they'll be able to move products out after that. I think it's more of an issue for people who are stuck in the port or ships waiting outside. I mean, I've seen some horrendous satellite images of the congestion at Shanghai. So if you're still on a ship and waiting to get in, it will take you longer. But our products, our first shipments in, and I suspect in a few weeks' time when that lockdown starts to become unlocked, then product can be distributed. So it's a bit too early to tell how soon that'll pick up. I mean, we don't know on China ourselves, but that's the position for us at the moment.
Yeah, I mean, my latest, or what I heard on CNBC in terms of Shanghai, was that they were hoping to ease the lockdown next week, actually, because I think the zero tolerance is actually working. But hey, how sustainable? I mean, they must be under so much pressure, basically, to sort that one out, because it will be damaging their their economy.
Yeah, and I think. Sorry, I'd say just what's important as well, Paul. I mean, obviously we've got a pretty small for China our numbers this year, because we've been very sort of conservative. So again, we haven't got big expectations for 22. That will start to come through more, we think, in 23.
Yeah. And then, Danny, can you just talk through the sort of the mix effect of the sort of venture life sort of customer owned brands compared with sort of like, your distributor owned or other people's brands? Because it seems as though you've got a gross margin mix effect which is happening there.
Yes, absolutely, Paul. And there's quite a difference between the two. So our venture life brands are the far more profitable part of our portfolio. When I say venture life brands, I mean the brands that are owned by Venture Life. We support the A&P activity around those brands and the marketing. We own the IP. So those brands generate around about a 15% higher gross margin than our customer brand business through the distributors. So it's part of Venture Life's strategy to buy and build, and then build those brands. We're building the more profitable elements of our portfolio, which is our venture life brands. So what we'll see from that is that through the M&A as well that was completed last year, which is margin accretive M&A to the gross margin percentage of the group, is that we can gain confidence, and we're starting to see already that positive gross impact at the percentage basis is coming through our numbers. And it will continue to do so as we grow those venture life brands, because they are the more profitable part of the portfolio.
And can you just remind investors what percentage they are now of the sort of like what expectations in terms of that,
Yeah,
your
absolutely.
own brand? Yeah.
So as of on a pro forma basis coming out of last year, these venture life brands account for nearly 60% of our portfolio now. If I go back a couple of years, the venture life brands accounted for between 35 to 40%. So that's a significant step up. And it's for the first time in Venture Life's short history that there is over 50% of the group portfolio is coming from its own brands. And this gives us confidence that we're in control of those more profitable elements of our group.
Yeah, that's good. And then, Jerry, just in terms of the sort of promotional and marketing sort of a spend and investment, which brands in particular are going to get the sort of the lion's share of that going forward?
Yeah, that pool's going to be particularly focused on the brands we've acquired last year. So the Balance Active and Lift. I mean, they performed very well in the back half of last year, as you've seen in the results, and they continue to do so in the first half of this year. So that's where we see significant upside opportunity in the market. We've got new product development planned, but the significant proportion of our A&P spend in the UK will be going into those brands. On the oral care brands, they've done well over the last few years, but that's in relative terms, because the oral care market has been falling consistently for the last 4 or 5 years. And within that landscape, we've managed to obtain market share, get better position. Dental is now the 4th mouthwash in the UK. Behind, the big ones are Listerine and Colgate, etc. So they've done well, but they've done well against the backdrop of a falling market. So we're not going to put so much A&P into those this year, because we think we've stabilised those. They've got a sort of maintained position. But those other new brands we've acquired have got a lot of growth potential, and that's where we're going to be focusing.
And what about the oncology side of it? I think was it Pomte? Is that another one?
Yeah,
Which is,
Yeah. So really good interest in those. So Pomi-T is already sold in the UK market through a distributor, and longer term we'd look perhaps to bring that in house. But we've had a very good international interest in both Gelclair and Pomi-T, particularly in the US and other major markets. So really good there. I mean, those revenues, again, those products grew their revenue second half of last year, 2021. But again, they're doing well this year, and we see there's really strong potential for those in the international markets.
Great. And then, Danny, assuming Jerry grows all those brands, which is his small responsibility, just in terms of the operating leverage, particularly in terms of your manufacturing footprint with sort of like spare capacity, how is that going to sort of like work through in sort of EBITDA drop-throughs and in terms of future investment capex? Because you do seem to have quite a lot of sort of like spare capacity just ready to be filled by new volume.
And you're absolutely right, Paul. I think investors are quite aware that there's lots of capacity still available in the sites. Now we have 2 sites. We've got the facility in Sweden following the BBI acquisition, and we've got the facility in Italy. And significant investment has been made in both of those facilities in recent years, which means there is lots of capacity. There's over 50% capacity in those sites at the moment. So we've got no need for immediate investment in the short term to build out those sites further, because the capacity is there. And to answer your question around what impact this will have on the EBITDA flow through as we grow those brands and increase our revenues, what we will see is a significant benefit from increasing our operational leverage. So in these sites, we've got the infrastructure, the people to deliver and produce the goods. So when we get an incremental impact on our revenues, there's a very low direct cost impact outside of the specific raw materials and components that go into making that product. And what we think will happen over the next couple of years is that despite the energy cost pressures that everyone is seeing right now, we've also got our mitigation strategies in place around our cost price increases, and we still believe our gross margin will grow between 2 to 3.5% over the next couple of years through that increased operational leverage based on those revenues coming through and growing, allowing us to do that. And the majority of that will flow down to EBITDA, because although we have built-in investment for our A&P and marketing, like I touched on earlier, the majority of that incremental gross margin, you would expect that we will see that flow down.
And then I'm guessing if you do sort of like new products, etc., or you do a bit of M&A and bring things on, then you've actually now got effectively a capital light model, because you can essentially lift and shift new products in and presumably potential acquisitions onto that existing manufacturing footprint, presumably, Danny. Yeah.
Well, absolutely. Jerry, it's possibly a question better for you on this one, but I would agree, Paul. Where we are is that we've got high-class machinery in place. The business has invested significantly, as I mentioned, and we've got the filling and packing line in our Swedish facility, which is state-of-the-art machinery. So we've got the right resources and the right machinery in place to allow us to drive the profitability up in the business when we get these incremental revenues come through.
Yeah. And then, Jerry, just on that one, in terms of the M&A, can you just talk us through what areas you're looking at, with geographical, sort of like zones or product areas you would like to beef up, or new product categories, etc.?
Yeah, I mean, I think the 3 areas where we're going to be focusing on M&A are our 3 sort of what we consider our core target therapies now, which is women's health, which is obviously where the Balance Active portfolio sits, diabetes support, where the Lift product sits, and also in foot care, because we've got a number of products in foot care and we see good potential. So those are 3 areas where we see good market growth. We see a lot of space in our portfolio and a lot of capacity to produce, and a lot of interest from the customer side. So that's where we're focusing. Predominantly, it will be UK or Europe. That's where we look to acquire assets, something that's got revenues and is established in one of those key European markets that we can then expand to others. We have started to look at the US. The US would only work for us if it came with an operation or a structure where we could use that to leverage more of our products. So that's a slightly more specialized target, but we are beginning to look out there. But there's some interesting opportunities out there.
And if you went into the US, would that be a sort of like a larger deal, presumably? Because I mean, that would be a huge opportunity, potential transformational sort of like, because I mean, it's just a massive healthcare market, and they're obviously really into, they pay for themselves rather than actually having any government support.
Yeah, I mean, it's a different market from Europe. Look at sort of, the five major sort of pharmacy type retailers. They're much more price driven, than perhaps in Europe, which is a bit more quality price balanced. But yeah, it would be potentially a significant acquisition. But as I say, it would be a footprint that's paying for itself already that we can then leverage with more of our brands. Otherwise, we'll continue to leverage our brands through distributors in that space.
Well, that certainly whets my appetite. Now, just on the operational front, you've had a good positive start to the year. Obviously, even though you've got sort of like, there's ongoing supply chain issues. Can you just walk us through sort of like the outlook, Jerry, just top level in how you see sort of like 2022?
Yeah. I mean, I think as Danny sort of alluded to earlier, and you did, obviously we finished with a very good sort of second half, and particularly Q4 last year, and that's continued this year. The supply chain issues have sort of not altered, but they've enhanced how we're operating with our customers. So the bigger issue in 2022, whilst price has been an issue, probably for a good 12 months now, it's timing of supply of raw materials and packaging. The disruption there has been extending lead times quite significantly. So items that maybe were 6 to 8 weeks lead time before, particularly packaging, now can be 26 to 28 weeks lead time. So, the cost implication we've been dealing with anyway, with cost price increases, etc., with our customers. But now what we've got is making our customers order a lot further in advance than they would have done ordinarily. I mean, typically an order lead time for a customer for ours. So this is the if you like, the distribution part of our business, not the UK and Ireland, but everywhere else. That was typically 3 months before. And now we're getting customers to order as far out as possible, and even to the end of the year, if they can. And we're not finding any resistance for that, which I think is quite interesting, because what it's showing, we think, is that there's still positive sentiment about consumer demand. And what we're doing with particular orders, if it's coming in and the order, there's been a price increase on the order, then before we confirm it with that customer, we're saying, look, it's going to cost you this much extra for that order, and we're going to invoice you for that to protect our margin. And there's no resistance, because as far as they're concerned, continuity of supply is far more important than an increased cost. So that's generally what's happening. So we've got greater visibility this year about our full year revenues than we ordinarily have had in the past, because of this extended order lead time from customers. So yeah, we started the year well. We're trading with where we expect to be. There are, I have to say, significant challenges in the supply chain, but we're managing those. We're managing those with ordering supply side further out, putting through customer price increases, and they're being accepted by all our customers, whether it's an international or in the UK. And so, we see challenges, but we see, the strong mitigations that we have to deal with those. So, we're very sort of pleased with how the business is coping with that, and its resilience, really, because, we've demonstrated for a number of years, in changing environments, we can be very resilient, and that's being seen again this year.
So a big picture then, effectively, there's difficulties and challenges, but the business is effectively on track with, say, what Singers are saying, I guess, from yeah. That's good. And then just Danny, just on that order book, is that, it sounds as though we've got a record order book at the moment, or there and thereabouts. We must be sort of like hitting that with greater visibility.
Yeah, indeed. It's quite exciting to look at the moment, Paul. So we're managing and reviewing, monitoring our order book very closely these days in light of the supply chain challenges that the world's seeing. So, by the fact that our customers are ordering out much further in advance than they would normally in his historic years, that's giving us the opportunity to secure supply with our suppliers much faster as well. Because if we've got those customer orders in the bank, that means we can place those supplier orders with more confidence and help them gather the components that they need to secure our supply. So that gives us a real confidence around the visibility for this year's revenue. And with the acquisitions of the BBI business again, and more retail business going through the Venture Group now, we've also got more visibility over those naturally recurring revenues that happen month to month of retailers and pharmacies. So there's a cluster of things coming together, which creates a great level of optimism around our ability to deliver in line with the expectations from Singers, and give us confidence that will only continue based on what we're seeing in the order book.
I mean, you're trying to build more sort of finished goods stock at all, just to give you a bit of sort of like wiggle room in case, your customers need more product, etc.
Yes, so indeed. So we are making sure we produce the goods for our customers faster, and that we're able to secure that supply, so that we can be flexible. We aspire to be a customer services focused business. Okay, and we want to give that flexibility to our customers, and therefore by producing some of these goods faster and securing those raw material components faster, we can be more flexible. And that does mean that our inventory days are going up a bit at the moment, but we think that's for justifiable reasons right now, and we'll see an unwind on that as we get to the latter parts of the year.
I think also, Paul, that makes a lot of sense, because we all know, even with what's been going on for the last 3 or 4 months, no one really knows what's going to happen the next 3 or 4 months. Is this going to get better or worse, whatever? So building up a bit more finished goods inventory means we're just accommodating, I suppose, any potential risk and protecting against perhaps changes in that in the future. So, we've got plenty of cash in the balance sheet, we're generating good cash. So it's a sensible thing to do. The other benefit is when we're making for customers on a distribution basis, we're buying raw materials and packaging, we're ordering it for the rest of the year for a lot of those customers. And that means we've also fixed the price. And therefore that gives us a bit more sort of certainty about that margin protection.
That makes perfect sense. Now, Jerry, nobody will hold you to this, but if we sort of look at the crystal ball,
everyone does.
I know, but we look at the sort of crystal ball, 3 to 5 years, etc. I mean, I think Singers have got 40 million revenue for this year, for 2022. How big could this business go? And also, what sort of percentage split would it be between your own brands and other parties? So let's assume it's a 60-40 at the moment, was exit. Yeah. And you did, what was it? You did 33, just south of 33 this year, but on a pro forma of 38, etc. In that sort of, how large, what's the sort of the ambition of the board?
Yeah, so I think there's a number of factors that play on that, Paul. So if I sort of start in reverse, the 60-40 split that we saw at the end of the year, I think it's important to emphasise that wasn't because the customer brands is going down. It's our venture life brands are growing faster than the customer brands. So both parts of that business will continue to grow. I think the venture life brands will grow faster because there's greater growth potential. Plus, when we acquire in the future, we will be acquiring brands, so we'll be adding on more brands. So I don't think it's going to get to 99 and 1 for a while, but you can certainly see it moving up towards 70-80% over the coming years of venture life brands. And I'd emphasise it's not because the customer brands is getting smaller, but because the venture life brands are growing much quicker, and obviously they're the higher margin brands. And I think we've if you look back over the last 5 years, our compound annual growth rate's over 20%. And half of that's attributable to organic growth and half of that's attributable to acquired growth. And we've done that analysis in a lot of detail. So we expect to continue on that track, so organic growth rates of over 10% and M&A growth rates of over 10%. So, if you're putting that kind of, those sort of numbers in, then you're going to, double, if you could, at the top, double revenues in 3 to 5 years, or in between, depending on those rates. So we're very comfortable with those rates. We see that in the portfolio we have. We see the opportunities in the M&A, and we've delivered that for the last 5 years. So, we're confident in being able to continue to do that.
Great. And then just finally, Danny, in terms of news flow going forward, we've got these at the AGM sometime, have we? I don't know when that is. And when's the next sort of trading update?
Yeah, so I think what we're working towards is at AGM 20th of June. That's the plan. Right. And we'll issue a trading update, obviously in September after our half-year interims. I think we'll hope to get something out before then. But the board are just managing and seeing timing of new deals at the moment, and we'll make that decision internally. But so no key changes or imminent announcements due, Paul, beyond today's update. But we'll let you know if there's something to share.
Great. Well, appreciate your time, gents. Congrats on certainly the second half of last year. Absolutely terrific numbers, and I look forward to hearing how the business progresses for 2022.
Great. Thanks very much for your time, Paul. Thanks.
Fantastic. Thanks, Paul.